right. Hi, Gabriel Josiah here. Okay. Today we'll be looking at module 3 in our financial statement analysis, which is unit 7. So we're going to the third module. We looked at in the last class, module 2, which has to do with profitability ratios. So we're going to look at module 3, which is liquidity ratios. And we'll be describing in this brief introduction, I will do a build-up on this foundation we have with the introduction, and the build-up is going to contain graphical examples and descriptions, practical calculations on how to calculate the liquidity ratios practically. But for now, let's look at a brief introduction of what the liquidity ratios are all about. So let me share my screen quickly like I do, and let's delve into it practically. Okay, you can see my screen right now. Liquidity ratios evaluate a company's ability to meet its short-term obligations using its most liquid asset. Short-term in the sense that you have a 1-year period span. Let's say 1 to 3 months, a quarter, 3 to 6 months, 6 to 9 months, 9 to 12 months, or within 1 to 6 months, half a year, 6 to 12 months, at most a year obligation. And that's practically what short-term obligation mean. So liquidity ratio entails the ability to meet these short-term commitments adequately. This is very important. These ratios provide insights into a company's capacity to quickly convert assets into cash to pay off its current liabilities. So it does this to ensure smooth business operations without running into cash flow problems. So we have your current assets, we also have your current liabilities. So this is for a short-term period, and your current assets are supposed to meet your current liabilities. Never should your current liabilities be above your current assets. It's going to cause cash flow issues, and the company is going to run into short-term financial difficulties. Okay, so liquidity ratios are essential for assessing a business short-term financial health, operational efficiency, and the ability to meet short-term obligations, and also avoid financial distress. This is very important. So your short-term financial health is dependent on how management is able to ensure that the current asset is above current liabilities, to ensure financial distress in the short term is avoided at all costs. So a company with strong liquidity ratios is generally considered to have a better ability to manage its day-to-day operations, maintain credibility with creditors, and withstand unforeseen challenges. This is very important. So your day-to-day running of the company, your day-to-day cost, expenditure, it's dependent on strong management skills and strategies to ensure that operations are on and unabated. This is very important. Liquidity ratios are valuable to investors, to creditors, and management, as they provide an understanding of whether the company can sustain operations in the near term and ensure timely debt repayment. So debt repayment in terms of short-term debts, short-term commitments to creditors, it's very important. So understanding how to manage your liquid asset is key, and that's the essence of this short journey we'll be taking on liquidity ratios. Okay, so that will be the end of this short introduction, and it's very important as chartered accountants to understand that liquidity of a business is what helps you in the now. And if you cannot take care of the now, you can't predict the future. So this is important. Your day-to-day operations, your day-to-day transactions are very, very important in understanding how to pave or pilot your affairs to pave a good future for the company. All right, that will be the end of this short introduction. And let me know what you think in the comment section. And don't forget to like, share, and subscribe. I'll see you in the next class. Until then, bye for now.